Right now, our economy is telling two completely different stories at the exact same time. On one hand, you've got this story of incredible booms, of record-breaking markets, and on the other, a story of deepening struggle. Now, this isn't a contradiction, it's a phenomenon called the K-shaped economy, and believe me, it explains a lot about the world we're living in right now.
So, let's just dive right into the central mystery, the question so many of us are asking ourselves. We see the headlines, right? Wall Street hitting record highs, tech companies valued in the trillions, and yet, for so many people, the day-to-day reality just feels tougher than ever. How can both of these things possibly be true at the same time?
Well, the answer lies in this really powerful visual metaphor, the letter K. It's used to describe an economic recovery that literally splits in two directions. For some, the affluent, people who own assets, and certain booming industries, the trajectory is sharply up. That's the top arm of the K. But for a whole lot of others, wage earners, small businesses, more vulnerable sectors, the path is downward. And that's the bottom leg. The two lines are just moving further and further apart.
So let's really break this down. We're going to dig into this tale of two economies. We'll look at the data that paints this picture of divergence and really try to understand how we got here.
To get a handle on the sheer scale of that upper arm of the K, just look at this number, 70%. According to the Federal Reserve, the top 10% of households now control roughly 70% of all the wealth in the United States. And this isn't just about income, right? This is about owning the assets, the stocks, the real estate, the businesses that are exploding in value.
And this timeline, it shows that this K-shape isn't some new thing that just popped up. It's a long-term trend that's been building for decades. Back in the 70s, the middle class was the clear majority. But since the 90s, that's been changing, and the gap has now widened to a 60-year peak. Yeah, the pandemic stimulus briefly helped, but the trend snapped right back, and with even more force.
And that is the absolute key. The pandemic didn't cause the K-shaped economy. It was what one source called the Great Accelerator. It basically poured jet fuel on a fire that was already burning. It pushed remote-capable knowledge workers and asset owners way up, while service sector workers faced massive disruption, pushing them further down. It just sped everything up, dramatically.
And that brings us to our next section, because if the pandemic was the accelerator, then artificial intelligence, AI is the engine driving this split today.
One analyst put it perfectly: the AI boom is the upward-pointing arm of the K. This massive wave of investment into AI infrastructure, data centers, and advanced computing is creating immense wealth. But, and this is a big but, that wealth is highly concentrated. It's lifting the stock market and benefiting those who own the stocks, while at the same time creating all this pressure on labor.
And this chart just illustrates how incredibly concentrated that boom is. In a recent year, a staggering 40% of the entire S&P 500's performance came from just a handful of tech stocks, the ones we now call the Magnificent Seven. This is not a broad-based rally, folks. It's a very narrow, top-heavy surge, and it's all being driven by the AI gold rush.
So, who are the winners and losers in this AI-driven divide? Well, on that upper arm, you've got asset owners watching their portfolios surge. You've got the companies building the AI backbone, and of course, the luxury and financial services that cater to all this new wealth. Then, down on the lower arm, you see the pressure. Wage earners whose purchasing power is getting squeezed, traditional sectors like retail and hospitality, and younger workers in jobs that are, frankly, looking more and more vulnerable to automation.
And this image, it just makes it real, doesn't it? We all recognize this scene. Traditional retail is a perfect example of that lower arm of the K. It's a whole sector facing a perfect storm. You've got fierce competition from e-commerce, and you've got strained budgets from your core customers who are all feeling the pinch.
Okay, but here's where the story gets more nuanced, and honestly, a lot more interesting. It's really easy to think of this as just a simple split between rich and poor. But the reality of who's financially secure and who's at risk, it is far more complex than just an income number.
So check this out. Research from Kearney breaks the K down into 6 distinct groups. And notice this, both the top and the bottom of the K have people who are comfortable, stable, and on thin ice. You can be a high earner on that top arm, but be completely over-leveraged, just one step away from financial trouble. And on the flip side, you can have a lower income, but actually be more financially secure because you live within your means and you have other buffers. This quote from the Kearney report just nails it. Imagine two people, identical backgrounds. One earns a huge salary in an expensive city but is stretched to the absolute limit. The other earns way less but lives a minimalist lifestyle in a low-cost area. Now, who is actually more financially stable? It's not the one with the higher income. It's all about your exposure to risk. And this brings us to this really crucial concept of financial buffers. These are the hidden safety nets that determine our true financial reality. We're talking about things like family support, living in a low-cost area, or having in-demand skills. These buffers are exactly why someone on the lower leg of the K can actually be more resilient than someone on the upper arm.
Okay, so knowing all of this, where are we headed? I mean, the current moment really feels like a crossroads, with two very different potential paths for the economy stretching out in front of us. Morgan Stanley lays out these two possible scenarios. In scenario A, the current trend just continues. The AI boom keeps lifting the market, and the health of the broader economy is basically tied to the fate of a few tech giants. In scenario B, things broaden out. Lower interest rates, maybe some other stimulus measures, could boost the labor market and help more industries, leading to more balanced growth. The catch? Well, that comes with its own risk of reigniting inflation.
And the outcome is anything but certain. As Lisa Shallett from Morgan Stanley points out, it's basically a coin flip whether these massive AI investments will actually pay off in the way investors are hoping. There's a huge amount of uncertainty baked into the current market highs. In fact, we're already seeing signs of what people are calling AI spending fatigue. Investors are starting to ask, hey, are the trillions being spent on AI ever going to translate into actual revenue and profits? And you know what? The parallels to the dot-com bubble, they're getting pretty hard to ignore.
So what does this all mean for us? How do we make sense of this new reality? Let's talk about the key takeaways from this K-shaped world.
For investors, this environment creates some very distinct themes. You see capital pouring into the companies building the physical backbone of AI. Real assets and commodities like copper and gold are in high demand, both as a hedge against inflation and as critical inputs for the tech build-out. And of course, the big, established tech leaders continue to benefit from this concentration of wealth.
But perhaps the most important takeaway for every single one of us is this new rule for understanding financial health. We have to stop looking at income alone. The real story is told by looking at a person's or a company's financial exposure and their hidden buffers. That is the new lens for seeing the economy clearly.
So the crucial point, the bottom line is this. The K-shaped economy isn't a temporary blip from the pandemic. No way. It's a structural shift decades in the making, and now it's being supercharged by technology. It fundamentally changes how we need to think about our economy, about risk, and about what financial security truly means.
And that leaves us with one final massive question. AI is clearly the most powerful economic force of our time. So will it become the ultimate engine of inequality, widening that K even further? Or can we find ways, through policy, through education, through innovation, to steer this incredible technology toward a future of more shared prosperity? That, right there, is the defining economic question of our time.